But Bryan sent me something, and he says, I have questions for today if you can. And Bryan says Chen/Sebastian, I guess this is another group he follows or another investors he follows. He says, number one, steep time value decay curve of options in the last 2 weeks or so applies to at-the-money options. Out-of-the-money options time value decays are in a linear fashion. Well, they're both sort of accelerated towards the end, but yes, it is more shallow with a deeper out-of-the-money option compared to an at-the-money option where you see that standard straight down curve in the last 4 or 5 days, 1 week or so, where it just drops down. Just like the time decay curve, we always talk about why we buy a married put that's 6, 7, 8 months out in time instead of 1 month out in time to avoid the massive time decay. And then he goes on to say, novice calendar spread traders, calendar calls or calendar puts, make the mistake of not closing out the short leg soon enough. Well, that's more based on the target and general rules, as opposed to trying to play time decay on a consistent value. And I'll explain what I mean by that in a moment. And then he says, card draw, value of low-priced options. The last 25% of typical OTM options expire slowly due to psychology of an option holder. I don't know if I 100% agree with that. We had a discussion a few weeks ago, Bryan, related to a gentleman who came across the discussion. He has a deep in the money sold put out to December or January. I can't remember which one. I think it was a 10 or 11 strike put, and the stock was trading around $6 or so. So he's close to 40% in the money if you look at it percentage-wise. And he came across something where it said that sometimes even deep in the money puts won't be assigned at expiration because the option holder decided not to do anything with the position. That's not exactly, I don't think, a true statement. We reviewed that in that previous webinar. What I mean by that is that the option holder is not linked to you directly. Option holders are all in a pool with the option sellers. So let's say I sold a call that's out of the money, getting close to expiration, and my price is waffling between 30 cents to 25 cents to 20 cents to buy to close this position. It is highly likely that the other side of the pool has already sold or closed those calls that are not working out for them, move them to other positions, and there's not an option holder necessarily on their side. The market maker is going short shares of stock and long shares of stock to make sure there's a fair market to cover the obligations if there is assignment. The market maker also doesn't want to let you get out of that position for something that doesn't benefit the market maker. Many times I have been 4 or 5% out of the money on a $50, $60, $70 stock, and the market maker up until the last hour is still setting the bid price at 15 cents and the ask price at 25 to buy to close the position. So we're playing that game where I'm trying to let it expire even though it's getting closer to at the money or it's right there, but they still want something. They still want something. There's nothing for free there. So I don't know if it's the psychology of the option holder. I think it's just the way things have always been. If they have some deeper insight into that, I'd love to see it. I haven't done the research into that myself. But normally, by the time, if I've bought a call and I'm on that side of the trade and you sold a covered call, Bryan, and we're getting close to expiration, my option's out of the money and I'm taking a 60, 70, 80% loss, I'm either selling to close that for what I can or rolling it because I think maybe I just mistimed it and I still have a bullish trend. That doesn't mean you're assigned early. That doesn't mean you can be assigned because it's out of the money. It just means there's no one holding necessarily all of the long calls that strike on the other side. The market maker is setting the price in a sense. He's not going to let you get something for free. And then you go on to say a few comments here would be interesting. Why risk the last week or so of holding sold premium and out of the money short options that are susceptible to large price moves? This comes down to what strategy you're doing. This comes down to your personal targets. Okay. And we're going to take a look at that in just a moment. But what I mean by that is if I'm selling weekly naked puts and I'm out of the money for protection, Bryan, and I took in only 35 cents for, let's say, a 7% out of the money put on a $60 stock, $70 stock, for example, I want as much of that time premium in my favor as possible. That's my goal. That might have only been, as you can see, a 0.5, 0.6% return for a 5-day trade. I want as much of that as possible. I'm holding it as close to expiration as I can because that is my trading plan. If I sold a 30-day output and got 1.5% return for 30 days, or let's even say 2% yield, and I'm coming up to the last week of expiration, and they're saying that, oh, the out of the money is decays in a linear fashion, so you know you're not getting much decay. Why would you leave it open? Well, that's also depending on your trading plan. Our trading plan is that if I sold a call option on a covered call or part of a married put or a collar, or I sold a naked put, for example, 1 month out in time, and going into the last 7, 8 days or so of the position, Bryan, if I've made 80% of what I expected to make due to the time decay, yes, I'm likely taking that off the table. If I collected $1.10 and the buyback cost leading up to the last 5 days is 45 cents or 35 cents, I'm leaving that open because I want to try to get to 80%, 85% of what I expected to make on the position, or still have it expire worthless to maximize the position. But those that are trading the weekly positions, naturally, this idea, why risk the last week or so of holding, is because that's their week. Even 2 weeks out in time, they're holding it as long as possible to expiration to get the maximum return on the position. And that's the sort of thought I have on your question here of why hold it that last week when it's susceptible to large price moves. 2 thoughts on that. We just explained the first one. The second one is, if you're in a position that's out of the money and you have a profit, but you're concerned about market conditions, honestly, if I was in a naked put position going into the end of this week and I knew the inflation numbers were coming out and I was scared that they were going to be bad, yes, I probably would have closed it early, Tuesday or Wednesday, for only a 40, 50, 60% profit, rather than take the chance of the declines we saw in a lot of stocks today of 4 or 5 or 6%. Absolutely. But not every week is like that. Not every week has an announcement coming up at the end of the week in this fashion. So again, it all depends on your trading plan. If you're trading shorter term, you're trying to maximize the premium as much as possible in that case. And this follow-up to that, why risk the last week or so of holding sold premium on OTM options? This is actually explained. Let me pause the screen. In a different structure. It's explained in the sense of bull put credit spreads. We had a discussion. I'm going to change the screen now over to YouTube, ladies and gentlemen. There we go. And we had another one later on, but we had this discussion with Jerry on 2 ways to trade a strategy, bull put credit spreads. This was 8, 9 months ago. And I typically look 14 days out in time on these positions. For the approach that I mentioned, even for Don just a moment ago, with those criteria that we would look for. Actually, again, you saw previously in discussion why I haven't been trading those recently. But Jerry brought us an issue. He says, okay, well, I saw someone else say that you should be selling 30 to 45 day out bull put credit spreads with a probability of only around 70%, looking for a 20 to 25% return, but closing that position when you're 10 to 14 days into the trade if you made half of what you expected. That literally comes down to the same exact thing I'm doing, but using shorter term 14 day out with a higher probability and looking for a 13, 14, and 15% return, holding it as close as possible to expiration. So why complicate it with the extra adjustment? But again, that comes down to the fact that I decided to go shorter term, so I need to hold it longer and closer to expiration to get that 80% of I want. And yes, I took in a lower net credit up front, whereas their approach was to go further out in time, use a lower probability, 70%, 65% or so, looking for a 25% return or so, but closing it when you reach near 50% profit, which was 12.5%, 13%. Essentially the same thing I'm doing in the same time period. Multiple ways to skin a cat. That's why the cat view is there, but you can check that out for a little bit more discussion. Your trading plan, your goals. I mentioned that my goals for the bull puts are not Don's goals. We reviewed that. And my goals there for the bull put credit spread might not be their goals, but then why complicate the position by looking to close it early when you could just do a shorter term in that case and still achieve the same goals? Quick follow-up here for the other parts of your discussion. I saw that slide in the background, Bryan. And here's the bull put credit spread we talked about for Don, that 35-cent net credit, 1.4% return. This is 30 to 45 days out, but as you mentioned, it's a deep out-of-the-money option that was $5.45 sold option for 35 days to expiration. And what I'm going to do here is we're going to go to the I do it from the, I hope, yeah, I'm going to go to put research tool real quick. This just shows you the history of the option price versus implied volatility. You've got some other things that you can check there, you know, option bid versus volume versus stock price and so forth. But what I wanted to do here, which I can't do directly from the portfolios, I want to go to calculators and Black-Scholes. And this is what they're referring to. Deep out of the money options do see a rather steep decay, but the last few days it is more linear, getting to the bottom of 1 cent. This is the expectation, of course, Brian, if the stock stays at the same price it is right now. Stays at 3,900, 3,125 put, and we're decreasing, we're seeing the decreasing, but then last 10 days or so, last 7 to 14 days, it's pretty linear as the expectation, assuming volatility remains the same, assuming stock price. Now, if the stock price drops down to 3,700 or so, not saying that's an expectation for SPX, but if it did, it sort of changes the decay a little bit, but it's still rather linear in that case. Now, let's change that up. Let's go back to 3,900. And let's go to the 3,900 strike. Can't get more at the money than that, can we? And this is what you expect to see with an at the money option. I agree with the statement is what I'm saying to you. I just wanted to show it graphically, Brian. Deep out of the money options will have that more linear regression. They're going to go to zero or low value faster, but as we talked about, the market maker is always going to want something. Where you expect it to be only 1 or 2 cents to buy back, he's going to have it, the market maker, I should say, or the electronic market maker is going to have it at 5 or 10 cents, something along those lines. Not quite what you expect. So again, I agree with that statement for your number one question. That is true. And you mentioned this point that I guess they also said calendar spread traders make the mistake of not closing out the short leg soon enough. And so I don't think they're talking about here for an at the money option that they might have been. They might have been talking about for the out of the money option. Let's just go to 3,200 here, where they're expressing, that's not the one I want. Let me go back just to the straight calculation that we saw. I apologize. Fantastic. So they're maybe saying that you should be buying back here rather than waiting these extra 10 days to realize the profit, or rolling it if you're continuing the trade. And then the last 25 or so decays more slowly due to the psychology option holder. I don't know if I agree with that. And then your final statement, why risk the last week or so of holding? It depends on what your trading plan is. Are you trading weeklies or 2 weeks out? Yes, you're holding it as long as possible to get the most return. Did you sell a 30-day out option? You're 2/3, 3/4 of the way through it, and you've received 75, 80, 85% of what you expected to make. Roll it or take it off the table. Absolutely. Okay, that's what we always say. But if I'm 5 to 10 days to go and I've had a position open for 20 days and I'm only realizing 30%, 40% of profit because the decay didn't work in my favor, the market pulled back, let's say in the case of a short put, I'm probably holding it a little bit longer to realize more of that return, Brian, that I originally targeted as part of my trading plan as well. Whatever that was. 30 days out, want to make 2%, 2.5% naked yield with out of the money puts with a certain probability and strike price, or part of a calendar spread, for example. But 2/3, 3/4 of the way through it, if I'm at 80, 85% probability, I'm likely closing it or rolling it to continue the calendar spread. I'm just using that because you mentioned it in your questions. But if I'm not there, I'm probably holding it longer to hit my targets for what I wanted to see personally.